Hey everybody, Ferris Galleon here, coming at you with what is going to be a weekly installment that I do that kind of covers the macroeconomic indicators that are currently informing the market situation for particularly for the housing market. But the economy is a big spider's web of various indicators that can bleed into other sectors and stuff like that. So you know oil prices actually have an impact on the entire economy, including home prices and stuff like that, albeit indirectly, right, through the periphery. So there may be times where global instability or other industrial sector indicators might inform and bleed into what we talk about here. But primarily, we're going to focus on the housing market and just kind of go over some of the indicators, right, to kind of make everybody, a little bit more informed on like what governs or dictates the current housing market and what it looks like maybe in the next 3 to 6 months as well. But for this first episode, what I wanted to do is just kind of go through some of the top shelf, high level indicators. There's a chain of indicators that go from one to the other, and then loops back around to have that closed loop impact and effect, right? Because the market is kind of always fluctuating. So indicators that drive the market up, at some point it overheats or it gets too inflated or whatever, and then factors kick in that sort of drive it back down, and that's how you have sort of the fluctuating sort of mechanism that we see. And look at all these charts that we have here on the screen. There's an up and down sort of factor. Now, these are just roughly 2 years old, but as you can see, we scroll down here and we can go back. We can adjust the time frame for some different indicators as well. So we're going to walk through some of this, but just to give you a sense, what we're looking at here is a tool that I built called Market Desk, and I built this using AI. And essentially, what it does is on this top part here, what it does is pull in live data and information from Fed, which is the Fed's primary keeper of the flame when it comes to all things economic indicators and data, demographics, etc. So these are all live, real-time dated indicators that are being pulled directly from the Fed website. Here gives us a chance to add indicators that we want to look at. That can help paint an additional picture of how the market's doing. Can also adjust the timeline to get a more of a historical perspective. And then we scroll down here. We can actually drill down by county. So I'm in California. I live in Nevada County. So we're going to come down here, Nevada County, and it'll just pull some, of the primary indicators for whatever county in the country that you're trying to look at. And again, all of this is being pulled live from the Fed website. So pretty cool stuff. Taking a little longer than would have been ideal for a tutorial here, but as it thinks and populates. Oh, there we go. So it just popped up here, and we have all the active listings in Nevada County as of the end of May. And this is always going to be a month behind, again, because it's pulling from the official Fed website. And so the June update will be reflected as of tomorrow. So today's June 30th. So as of July 1st, the June numbers will be populated, and this will automatically update. But we have, active listings, new listings, pending, reduced pricing, all this kind of stuff. So then we have the news digest, right? So this is another feature that is actually pulling every day. It updates. In fact, this one was 25 minutes ago, so I guess every hour it's pulling new headlines in from all around the internet that have to do with the housing market. And so what we'll probably do as we go through this, because I'm still, I'm not super comfortable on camera, and I'm still kind of finding my voice and finding the cadence and everything for this whole weekly episode. But what we'll probably do is come down to here, this news section, click on a few headlines that seem interesting, and kind of pull apart and assess, using economic indicator analysis, like what is going on in the market, right? And then we come down here, and this is just a cool little area that kind of, provides amplified information on like what each indicator means, right? So it gives you what the definition of the 10-year Treasury yield, right? It gives a historical context of like what the current rate at 4.38% means in a historical context, right? So the yield peaked at 16% in 1981. So we haven't been near, the highs in a long time. And, it helps us make sense of the current moment when we can place it into a historical context. Then we have like rules of thumb, right? There are certain economic indicators that, if you are above a certain percent, for a sustained period of time, say 3 months, then that signals that there's, an economic recession or something like that, right? So this area just kind of gives us a sense of like, okay, this is the context. This is how to interpret that. What does it mean for it to be at 4.5%, for an extended period of time, et cetera. And then these are the economic indicators that drive this particular indicator. And then these are the downstream effects of what happens when that economic indicator is, moved one way or another, right? And so we have it for all the different indicators. It's a very valuable tool that I'll be using to kind of go through this. But what I wanted to do is start with the chain, the primary high level, macro level indicators that drive housing market. And you always hear like a lot of times, oh, the Fed is going to cut interest rates, and what does that mean? Well, most people don't realize this. I don't want to say most people, but I think a lot of people sort of use the Fed interest rates interchangeably with mortgage rates. And if you didn't know this, let me be the first to tell you that the 30-year fixed mortgage rate and the Fed funds target or federal interest rates are not the same. They are not the same thing, and they don't track the same way. The far more informative indicator for what influences the 30-year fixed mortgage is actually the 10-year Treasury yield. So if we scroll down here, going all the way back to 1978, we can see that the orange is the 30-year fixed mortgage, right? And that the black is the 10-year Treasury yield. And you'll see that they follow almost verbatim, right? They have a very close tracking mechanism. And there's always going to be a buffer between the 30-year fixed mortgage and the 10-year Treasury yield, because there's got to be a risk factor baked in, right? And so essentially, just to kind of take it to the top here, the 10-year Treasury is the yield, is the return that investors can expect from a 10-year government bond or fixed income, right? So it's essentially the government saying, hey, look, you give me $1, and in 10 years, I'll give you $1.10. Now, that doesn't seem like much, and that's a very small example. But this is the type of investment vehicle that investors will usually go to when they're looking for a safe haven, when maybe the economy is not doing too well, or even pension funds or insurance companies or very large institutional investors are always going to have a certain percentage of their investment portfolio wrapped up in safe 10-year Treasury bonds, just because it is one of the safest havens that you can store investment. And so, the 10-year Treasury yield is very closely aligned, or the 30-year fixed mortgage and the 10-year Treasury map so closely together because in many ways they're a similar type of investment, right? They are a long-term investment opportunity, and 10 years is about the time that people tend to hold their mortgage, and so they very similar investment vehicles, right? And so that's why they have very similar yields on them. And so the reason why the 30-year fixed mortgage typically remains 1.5 to 2% higher than the 10-year Treasury is because it's more volatile, right? People can refinance, which changes the entire, the return, structure. And people will sell their houses, or there's different things that will happen within 10 years that is considered a risk factor for investors. And so when we're talking about investors, by the way, obviously a 30-year fixed mortgage is like somebody buys a house, right? They're taking out a 30-year mortgage. Perhaps you'll remember a term called mortgage-backed securities, right? And this, was a term that was made famous during the Great Recession and the 2008 financial collapse, where it's essentially institutional investors will take a basket, thousands of mortgages, right? And they'll buy them, and in a basket of mortgages, and that's like an investment, right? Because they are getting a return, a specific return based on people paying their mortgages at a certain percentage, right? And so that's why the 10-year Treasury and the 30-year fixed mortgage match so closely together. But the way it tends to work is, the 10-year Treasury is very closely linked with the Fed funds rate, or the Federal Reserve interest rate. And typically what happens if we think if there's high inflation or low unemployment, right? These are the two primary indicators that the Fed uses to determine whether or not they're going to raise or lower rates. And if you let's just say high inflation, for example, because we are kind of remain in a fairly high inflationary period, right? So CPI, Consumer Price Index, is the generally the inflation rate that the Fed uses to make that determination. We're still at over 4%. This is still much better than it was in 2023, but let's just say the market conditions have sustained in terms of the housing market. Primarily due to inflation remaining a problem. Okay, and so let's say you have an inflation spike, which could be due to any number of factors, and typically it's a myriad of factors that drives that. But the inflation rate will spike, and then that causes the Fed to raise rates, right? Because high inflation means that there's a lot of spending going on, a lot of demand for goods and services. Higher demand drives prices higher, right? This is kind of basic supply and demand. And as prices get higher, that's inflationary, right? That's an inflationary pressure on pricing and everything like that. And so in order to rein in inflation, the Federal Reserve will lower interest rates in order to put a tool on the economy and try to bring things down to a more manageable level. Similarly, the unemployment rate has a similar factor, except it's the inverse, right? So low unemployment means that more people in the United States are employed. Higher employment means that people are buying more goods and services, which is having an upward inflationary pressure on the cost of goods and services, right? So those are the two primary factors that the Fed uses to determine its interest rates. When the Fed chooses to raise interest rates, okay, that sends people away from the 10-year Treasury, right? So the 10-year Treasury, it's typically, again, it's a safe haven for institutional investors. It's a place that they're going to get a guaranteed return, and that when the Fed raises interest rates, that forces capital, that drives capital from low interest yielding investments like a 10-year Treasury into higher yield interest yielding returns into like shorter term bonds or things like that. And so when the capital flees the 10-year Treasury, that means that demand is going down. And when the demand for the 10-year Treasury goes down, that means the yield for the 10-year Treasury is going up. Okay, so you can always think in economic terms that there's a lever, right? When this one goes down, this one goes up, and there's always going to be in the immediately adjacent, economic indicator, chain, that there's always going to be some pressure that pushes one thing up and the other thing down. And never say never, but very rarely and only in very unique circumstances is it the case that you can have an indicator move one direction and not have an impact on its neighboring indicator, right? And so when the 10-year Treasury yield goes up, that usually brings 30-year fixed mortgage prices up, right? As we've already seen, these map very closely together. And so when the 10-year Treasury goes up, you can expect to see in the not too distant future that the 30-year fixed mortgage is going to go up, right? And what does the 30-year fixed mortgage rate have to do with the home market? Well, most of you probably can tell, but mortgages is how most people buy property, right? And the interest rate, the mortgage rate, is the cost of borrowing, right? So if mortgage rates goes up, then the number of people who can afford to buy or who are able to get into the housing market as buyers is going to go down, right? And when mortgage rates goes up, that means the number of buyers is going down, which means demand is going down. And as demand is going down, that sends prices down, right? Because if less people are trying to make purchases in the housing market, then sellers have to adjust pricing in order to do that, which and there's going to be less sellers. Sellers don't want to sell for less money. So that means inventory is going to go down. That means the number of days that a house stays on the market is going to go up because buyers aren't buying and sellers trying to sell at a specific price. And, so it goes. And so this is how it starts to bleed into the housing market, right? So as prices are coming down, well, then buyers start to recognize like, oh, okay, I can now afford that house. So I can now afford to enter the housing market, which starts to correct the market. And when you hear about market corrections, that's what's happening at a fundamental level is, the market has moved and drifted in a particular direction for long enough that natural forces start to correct it and push it back and apply pressure in the opposite direction, right? So as housing prices start to fall, more and more buyers start to recognize that they can get back into the market. They start to buy prices, which starts to put upward, pressure on housing prices again. And this is how we get into the housing cycle. And so, this is, hopefully not too convoluted. It made sense to me, and perhaps this whole chain of events is better served as drilling down in more specific pieces. I just thought it would be an interesting sort of exercise to kind of walk through exactly the forces that push the housing market in any particular direction, and we're gonna drill down again. Moving forward, we're gonna pull news articles, like just kind of like looking at this right now. America could have too many homes in less than 10 years, according to Newsweek. I don't know what that article says. Let's take a look. Americans have repeatedly been told that the current housing affordability crisis has been the result of a long-standing shortage of homes, not enough properties were built in after the Great Recession. Affordability has been strained so much that U.S. housing market risks incurring into a paradox soon, according to a new study. In less than 10 years' time, the nation could have too many homes. In a recently published paper, researchers at the Mortgage Bankers Association argued the post-financial crisis narrative of a persisting housing shortage may no longer accurately describe market conditions over the decades ahead. Right, and so, if we are having a shortage of homes or too many homes, right? So for a long time we were saying that we had a shortage of homes, but now if we are moving into a glut of homes, like too many homes, what kind of pressure would you expect to see on the housing market in situations like that, right? It's fair to say that you would expect housing prices to go down when there's an overabundance of supply. Again, the mechanisms of supply and demand. When supply is high, then there's more supply than there is demand. That has downward pressure on pricing and vice versa. So I think that's pretty basic. Most people get that. Not trying to speak down to anybody, but I think especially when you get into the weeds on some of this stuff, it's easy to lose sight of even some of the more simple mechanisms at play when we're evaluating the economy. So all that to say, I'm going to leave that there for now. I thank you for tuning in. If you get through the entire broadcast here, I thank you. I just want to say, and by saying, I am a licensed real estate agent. I am a former Navy SWO. I serve primarily veterans and active duty service members. However, I can serve anybody with any housing needs. Try to position myself less as a real estate agent and more as a strategist and consultant. I am a former analyst at one of the largest real estate consulting firms in the country. This is the type of firm that advises Wall Street investors on housing trends and things like that. Also have an MBA from Duke University, and I'm a military relocation professional. So I have the pedigree and the chops to serve people in a very unique way. And would encourage you to visit my website, farsis.com, where I've built a lot of really great tools that can help just about anybody who either owns a house or is interested in buying a house. Everything from an amortization calculator, how much money can you save if you spend a little bit extra on your mortgage each month? Events that are going on in your neighborhood all throughout Northern California. This is an events calendar, consolidated events calendar. Even if you're stuck on what to cook for dinner tonight, here's a tool called Plate Spin that, based on your dietary restrictions, you can actually decide, get ideas on what to make for dinner tonight. So just a few tools for you. And thanks for tuning in. And I'll be doing a more in-depth plunge into the market each week. And so don't miss it. Thanks so much.